Hi there, I'm Mike Larson, Editor-in-Chief at MoneyShow, and today I'm coming to you from the Investment Masters Symposium in Sarasota. I have the pleasure of speaking with Ann Sonders, Managing Director and Chief Investment Strategist at Charles Schwab. Ann, how are you?
I'm great. Thanks for having me.
I'm glad you could be here. I had a chance to listen to some of the comments you had before, and I guess if I had to sum it up, I'd describe your view on this market as cautiously optimistic. Do you think that's fair, and what are you seeing happen?
I think it is fair, but I think the tenor and the characteristics in 2024 are unlikely to mirror what we saw in 2023. 2023 was a year of pretty much no earnings growth, all multiple expansion, very concentrated performance up the cap spectrum. So I think for somebody to say the market was incredibly resilient in 2023 and leave it at that doesn't really tell the whole story, because at least until the beginning of November, you had such a small subset of stocks. And I think under the surface, leadership where it wasn't, was, I think, a little more in keeping with some of the macro uncertainties that we are arguably still facing heading into 2024.
Sure, and let's start with the macro picture. I mean, everybody's sort of with the Fed, it's will they, won't they, are they pausing, are they going to cut? Where do you fall down on that debate?
So I think it's not an unsafe bet that the July rate hike was the final in the cycle. Where I think there's still a disconnect is the market's embedded expectation of rate cuts starting maybe as soon as March.
Okay.
And it's hard to, as I said this morning, hard to square the circle a little bit in the components of that narrative, because it's often expressed in a very optimistic way, both for the market and the economy. Yet I think a scenario under which the Fed pivots as quickly as in March to rate cuts, not just staying in pause mode, probably necessitates more economic weakening between now and then. This idea that we could continue to have sort of immaculate disinflation, no hit to the labor market or the broader economy, and that the Fed would view disinflation as a sufficient reason to do a 180 and start cutting, I think that's a little bit of a stretch. So given that the Fed is data dependent, I think it depends on what the data does. And we already know that expectations for Fed policy have been a moving target for a while. Back in March of 2023, the Fed funds future market expected the Fed would be cutting already, like having started this past summer. That clearly was not the case. So I think it's not set in stone.
Got it. Let's talk about the economy and the sort of recession, no recession thesis, right? I mean, one of the interesting things you've talked about is the concept of a rolling recession. Before it was popular to talk about that. Can you explain what you're seeing in the economy now and kind of how you see that evolving?
So nobody wants to go back 3.5 years, but I think it has to be part of the rolling recession sort of narrative or explanation, because if you think about the stimulus era in the early part of the pandemic, at that time all the demand and spending associated with that stimulus was funneled into the goods side of the economy because we had no access to services. That was the breeding ground for the inflation problem with which we're still dealing, but it started on the goods side of the inflation metrics. Of course, it was exacerbated by supply chain problems. But then subsequently we had disinflation to outright deflation in some categories on the good side of inflation. We went into hard landings or recessions for manufacturing, housing related, a lot of consumer-oriented products and goods that were big beneficiaries of the stay-at-home era. But we've had the offsetting later strength in services, the revenge spending. Services is a larger employer. That helps to explain the resilience of the labor market. So to me, as I look going forward, I don't really view best case scenario as a traditional soft landing, because that ship already sailed for many of those segments of the economy. It would be a continuation of the roll through, whereby if and when services got hit and the labor market takes a bigger hit, that maybe you're in stabilization or recovery mode in areas that already had their own hard landing. So that's, I think, the appropriately nuanced way you've got to look at what we know to be a very unique cycle.
Okay, let's shift to the market environment that we're in here. Earlier in the year, you've discussed how it was the sort of Mag 7 to a degree type market. Now, as we head into very late in 2023, a little bit more broadening out. How do you see that situation evolving? And are you still concerned about the breadth issue?
So when you've got cap-weighted indexes that are biased in performance up the cap spectrum, even when it's a fairly small subset of names, in and of itself, that's not an imminent risk factor. It's often the case that cap-weighted indexes are biased in performance by a smaller subset of names. The problem arises when you've got the combination of that outsized performance contribution and the rest of the indexes dramatically underperforming. And that was what came into play in the early summer period of time, where you had a record low percentage of S&P names that were outperforming the benchmark on a trailing 3-month basis, on a trailing 6-month basis. It was the combination of the two at the extremes. Even since then, we've seen less of that other side. You've seen some sort of slow participation improvement, but really only since the beginning of November did that broadening out kick into higher gear, such that as we're sitting here for the past month, in a somewhat quiet way, Russell 2000 has outperformed the S&P over the past month. S&P equal weight has outperformed cap weight. So 1 month doesn't a trend make, but it's good news that we're starting to see that broadening out. And I think it's also indicative of a lot of money out there, probably both individuals and institutions, that are itching to find opportunities outside 7 stocks. So not a, and you know, sort of this stealth rotation, it's not a bad way to correct excesses. It's certainly, I think, probably an option that most would prefer over the bottom falls out all at once and you just get hit more by the larger cap stocks. A process of rotation can solve excesses without an epic decline.
And I think one of your big messages here was if you're looking to take advantage of opportunities in this market, it's invest based on characteristics, sort of the factor-based versus sector-based approach. Can you talk a little bit about that for someone who's watching?
Sure, and by the way, I think that's growing in importance and growing as a focus by institutions and individuals is making decisions, screening more based on factors. Factors is just another term for characteristics. So, in fact, a lot of stock picking models, ourselves included, our Schwab equity ratings, the engine of that to generate the A, B, C, D, and F ratings on 3,000 plus stocks is factor-based. Okay. So really it's just looking for certain characteristics. And the emphasis that we have had in the past year is on quality-oriented factors, but also specific factors that very much tie to the macro environment. And as I list them, it's probably going to be a lot of, oh yeah, that makes sense. So given the most aggressive tightening cycle in 40 years, looking for companies that have strong balance sheet, strong free cash flow, low debt and or high interest coverage, that maybe are making more interest income than they're paying out in interest on their debt. We've been in this earnings constrained environment, so companies that have positive earnings surprises or positive earnings revisions. And you can apply that analysis, that screening, across all 11 sectors because there are both opportunities and weaknesses in every sector. Yeah. And interestingly, there's been more consistency in terms of leadership in the past year plus at the factor level than at the sector level. So I think that makes sense to carry into 2024. The one added factor or set of factors that I think you want to throw into the mix in this sort of quality wrapper is valuation-oriented factors. So I think this is, given how stretched certain segments of the market, not least being the mega caps, have gotten, maybe making sure you also have a little bit of a valuation filter on top of all those other quality-oriented factors.
Well, I think one last thing that I took away from your comments earlier was that the research is more important. This is more of a instead of a rising tide lifts all boats environment when we had ZIRP and all of that. It's more focused on names and right. I mean,
well, that's the benefit of the return of the risk-free rate, because the ZIRP or NIRP era, negative interest rates, on the part of many global central banks. That certainly wasn't to the benefit of savers or income-oriented investors. It forced investors out the yield spectrum. It also caused a lot of capital misallocation. It meant the inability to do true price discovery. It was a prop and a support for zombie companies. So I think there were more negative consequences than there were positive consequences. And the return of the risk-free rate, I think, has brought back into the mix this notion of price discovery and fundamentals being reconnected to prices. Trends in interest rates and inflation driving valuation parameters and ranges. And I think that's, for the most part, a healthy thing.
Great. Well, I think that's a great place to end. We'll all see what 2024 has in store for us. Thank you so much for your time,
Thanks
Lisanne.
for having me.